I'd like to thank those of you who have been with us since 9 o'clock this morning for continuing to support us. And I hope you had a few minutes to get a refreshment before we get into our next session. Our next session is sponsored by the Intercompany Long-Term Care Conference. This year's conference, I beg your pardon, is going to take place in Denver, Colorado, March 12th through the 15th. I have to tell you that registration, if it's not open today, it'll be open in the next couple of days. The conference has 8 different tracks. You will get so much expertise at the ILTCI. They are a sponsor for NAIFA's Limited and Extended Care Planning Center and have been for a very long time. With that being said, we have to thank them for asking Ramona to tell us about hybrids, because we know, as we've discussed earlier today, that is a growing market and can be a very good solution as long as you, as the agent, advisor, or investment professional, understand the devil is in the details. So with that, Ramona, I happily turn it over to you.
Well, thank you. I'm happy to participate, and I hope it's okay that I share some slides to cover data. Is that okay?
Yeah, mine just didn't work, but I would have liked to have also. So
okay.
Please do.
First of all, I like the title, Don't Be Spooked by Living Benefit Riders. Really like the title. On the one hand, living benefit riders. When I think of living benefit riders, to me, they have a positive connotation. And that's because you don't have to die to access the policy benefits. So living benefits to me are very positive. For decades, we know that in life insurance, you could use the cash value to supplement retirement income. That's a living benefit. But with chronic illness and critical illness riders, also a living benefit, what you're doing is you're accelerating the death benefit while you're alive. You don't have to die. So to me, positive connotation. On the other hand, don't be spooked. Well, the reality is, so we're going to lift the rug up. We're going to add clarity, some rules of thumb to help you discern what type of rider solutions you've sold in the past, what type you are selling today. But in terms of don't be spooked, I wanted to add, the reality is some insurance companies have been named in lawsuits regarding these riders. And at the heart of the issue or the matter at dispute is the fact that the entire death benefit or a larger portion of the death benefit wasn't eligible to be accelerated for care. And so the question I have for you, for insurance professionals, is do we know that these rider benefit solutions vary significantly? With some type of chronic illness riders, you can accelerate the entire death benefit for care. With most of them, you can't. You can accelerate a fraction, and by how much you can accelerate, it depends. It varies significantly, and it could actually be jaw-dropping. So that's what we're going to do. We're going to lift the rug up and take a look at some rules of thumb. And why not just go ahead and be transparent right now? So we have tons of things to look at. Not tons, a few slides to look at, but let's just be transparent right now. Up front, if a rider has an upfront charge, if there is an upfront charge to the rider, chronic illness rider, critical illness rider, then we know that you have known and predictable benefits. If there's an upfront charge right off the premium or off the cash value, then you can rest assured you have known and predictable benefits, and you can accelerate the entire death benefit for care. Chronic illness expenses or any remainder will be payable as a death benefit. If you are selling a chronic illness rider where there is no charge until acceleration, so it's free, and it's never free, right? If you're not paying up front, you're paying on the back end. If you're selling the type of chronic illness rider where there's no charge until acceleration, then the amount eligible for acceleration depends. It could be a fraction, 30%, 50%, 70%. It could be zero. And those were the ones that were named. So we're going to take a look at some examples. And just as Carol said, this market has been growing. I will say, obviously, you're still accountable for your own due diligence. entirely, and there are some exceptions in terms of what I'm going to cover. Just a few minor exceptions, and then there's also, of course, state variations that always apply. Again, as Carol was saying, just really quickly taking a look, 20 years ago compared today, 20 years ago, you had a couple of LTC riders in the market, a couple of hybrid extension of benefits. Today, this market is growing. You got 9 and 10. How about chronic illness riders with upfront charges? I will continue to segregate them because remember, that's the rule of thumb. Chronic illness riders with upfront charges, I'm not aware of any. Today, you have 8. At the bottom, though, that's what's been growing in most popularity. And then, of course, also the ones that have been involved in some litigation. Chronic illness rider where there's no charge until acceleration. Most of your critical illness riders fall into that category too. 20 years ago, you had 1. Today, it would be too hard to count. There are tons of them. Just in general, before we take a deeper dive, if I were to ask you what the #1 trend in the life insurance industry has been in the last 15 years, I bet you a number of you would say it was Index UL. And if that was, if we were looking at product categories, I certainly would agree with that. But more broadly speaking, I would say and contend that the #1 trend in the life insurance industry in the last 15 years has actually been long-term care life insurance solutions. And that's because whether it's a chronic illness rider, a long-term care rider, or a hybrid extension of benefit solutions, these solutions transcend all product categories. And sometimes you could even find chronic illness riders on term chassis. This chart here is from LIMRA from the first half of last year. And you see it's broken out by policy count or premium or face amount. And again, whether it's an IUL chassis, whole life, or term, you can find these solutions there. I like this chart here a lot, this pie chart, also from LIMRA, first half of last year. When you're looking at all the solutions, whether it's a hybrid linked benefit in blue, or chronic illness riders, whether it's upfront charge or charge at acceleration there in green, or long-term care riders, when we look at those solutions, whether it's on a UL chassis, whole life, regardless of the chassis, we see that 50% of the time when broken out by premium, chronic illness riders are sold. So they are more popular. You are going to find them. In fact, we know with some of the riders, those where there's no charge until acceleration, they are often automatically included in the policy and there is no underwriting. So 50% of the time it's chronic illness rider, 35% hybrid, 15% long-term care riders. Now this is important. This slide I'm going to ask you to remember because when we compare on the back end, I want you to make a note of this particular stat. So we already have demonstrated that chronic illness riders are the most popular when compared to hybrids and long-term care riders. But when a chronic illness rider is sold, when broken out by premium, again, the stat from LIMRA, 86% of the time, it's the kind that is free, which I'm saying in quotes, because we know it's not free. 86% of the time, there is no charge until acceleration. 14% of the time, it's the chronic illness riders with upfront charge. When you have an upfront charge, you have known and predictable benefits. So let me ask you to consider this. Let's say that you had 2 identical policies here, 2 identical chassis. Underlying chassis are absolutely identical. You have the chronic illness rider with upfront charge, sold 14% of the time by premium, and I have the one where there's no charge until acceleration. Then we press calculate. Whose illustration looks better? Mine is going to look better. There's no charge, right? So there's no drag on the charges. So either my premium is going to look better or my cash value is going to look better. But don't be distracted by what looks better on an illustration, because just because something is easier to sell doesn't mean it's a better consumer value. So hang in there. We'll get to more details here. I know there's a lot of words here because I want you to be able to access it later, but look at the continuum on the bottom. I like the continuum because it's just a simple way to categorize these in your mind. Most robust benefits are on the right, hybrid linked benefit products with extension of benefits. You can get the largest benefit with these policies, the hybrid linked benefits, because they have a second pool of money, right? The first pool is the death benefit. You can accelerate the first pool, the death benefit. There's also a second pool, the long-term care benefit pool, that you can sign up for, 2-year, 3-year, or however many year duration you sign up for. So because of that, you can get a more robust benefit. Plus, hybrids are unique from other combination solutions in that hybrid link benefit products also offer inflation options. So you're not going to find that second pool, that extended pool with the other solutions, and you also won't find inflation options with the other solutions. In the middle, we have chronic illness riders with upfront charge and long-term care riders upfront charge. Again, our rule of thumb is if you're paying for the rider, you have a known and predictable benefit. That's where I have those two. On the left, chronic illness rider, no upfront charge. The charge is determined and calculated, and the benefit is determined and calculated at the time of claim. How much can you accelerate? It depends. Now, before we go any further, I do want to say on the record, because sometimes I forget this and I feel bad, all the rider solutions are good, all of them. All the rider solutions are good. The problem isn't any of the riders. The problem is are we adequately managing expectations on how they work? That's important. All the riders are good because the chronic illness riders with no charge until acceleration really have a good fit for certain sales applications, right? So if you have a sales application where your goal is to maximize cash value to like supplement retirement income, then you don't want the charge. You want to maximize cash value. So it just depends on what the client's priorities are. Just going to roll through a few slides here and then a couple of examples and then open it up to questions. Again, hybrid link benefit products with extension of benefits. I like the analogy here, a yacht, robust benefits. You're on a yacht. You're not only going to get to the other side, but you're going to get there in comfort. They are qualified long-term care, 2 pools of money. You can accelerate the entire death benefit and the second long-term care benefit pool. And they are unique because you have inflation options. So if you have a $500,000 death benefit, how much can you accelerate? Well, we know you're going to be able to accelerate the entire 500,000, and depending on the design, you might be able to accelerate 600, 800, a million. It depends. Some of these solutions, even have the opportunity to either grow the benefit pool, to grow the monthly benefit amount, or to grow the years that are scheduled to pay, to extend the years to pay. And sometimes those can be grown depending on non-guaranteed elements. And I really like that innovation in the market. So what we're saying is that the underlying non-guaranteed elements could be dividends. It could be if you're on an IUL chassis, the growth of the index. It could be if you're on a VUL chassis, the growth of the mutual funds, the sub-accounts in there. And again, that could increase the monthly benefit or increase the years to pay. But again, known predictable benefits, what makes them unique from other combination solutions in the marketplace is that you have 2 pools, the extended benefit, and that you also have inflation options. Long-term care riders. Now we are looking at a motorboat or a speedboat. They are qualified long-term care solutions. Yes, you can describe and market them as long-term care. And by the way, in terms of qualified long-term care solutions, of course, traditional long-term care, of course, hybrids, and then of course, these LTC riders. One thing anyone that we all know, anyone that experienced anything with the state of Washington and the Washington Cares Fund, is that it had to be a qualified long-term care solutions to exempt Washingtonians from the payroll tax, right? It had to be a qualified long-term care solutions. In other words, chronic illness riders did not make the cut. But anyway, long-term care riders, upfront charge, known predictable benefit. And just like hybrids and traditional long-term care, they meet all the regulatory requirements and they have additional consumer protections, to help prevent the policy from lapsing in terms of consumer notifications. Or even if the policy has lapsed, to have protections in place for a certain duration to have it reinstated without evidence of insurability. That's the privilege of qualified long-term care. On the other hand, we also know, kind of the drag is that you have to have it depends on state, but you have to have a health license and continuing education. But with that comes all these robust benefits. So you're in the speedboat there, you have a $500,000 death benefit, you can accelerate the entire $500,000 for care. For chronic illness expenses, cognitive care. And then I will say some companies have a residual death benefit where, for example, they'll have a 10% residual death benefit, either as part of the 500,000 or on top of the 500,000. So for example, you could accelerate the entire 500 for care plus still have 50,000 eligible as a death benefit when the insured passes away. Some companies will have that residual as part of the 500. So they would allow you to accelerate, the 450 for care and then leave the remaining 50,000 for as a death benefit when the insured passes away. The point is, though, the entire amount is eligible for acceleration. All right, this is why we're here. This is why Carol tapped me on the shoulder. And it all comes down to, as she said, the devil's in the details. If you don't know what type of chronic illness rider you're selling, then how can our clients know what they are buying, right? I mean, we really have to be accountable for that. And then what about if they have the perception that they can accelerate the entire death benefit, and then they go to make a claim, and of course they'd be crushed at the discovery knowing that they can only accelerate a fraction. So we've kind of already talked about it. Upfront charge is the rule of thumb. You're in the clear, known and predictable benefit, whether the charge comes right off the premium or, like with whole life, or off the cash value with other chassis. Look at the two other examples there, discount method and lien method, where the charge and or benefit amount are determined at the time of claim. The discounting method is by far the most prevalent. And those are the ones where depending on the age, the severity of your condition, your life expectancy, the discounting rate, depending on tons of factors, at that time they will tell you how much it costs and how much of a benefit you're able to accelerate. Now with the lien method, those are a little bit, you don't find those as much. Very quickly, I'll describe those to you. With the lien method, you're going to actually have a chronic illness benefit amount that is known. What's unknown is the remainder death benefit that will be paid to the beneficiaries. So with a lien method, let's say you had a death benefit of 500,000, and they will allow you right when you go on claim to have a predictable benefit. They'll say you can accelerate 250,000 or less or more, depending on that carrier specs. You can accelerate 250,000 for care. But what we're going to do is we're going to kind of count that as a loan against the remainder death benefit. And that loan is going to have compounding interest. So you have a known chronic illness benefit, but now what's unknown is the remainder death benefit. So the longer that you live after you've gone on claim, the lower that death benefit declines, to the point and potentially that there is no remainder death benefit, could be zero, again, depending on how long you live. The discounting methods are by far the most prevalent. All right, this is an important example. And now we're getting into the heart of why we're here. So let's compare an actual live example, two illustrations. Two sisters, Mary and Martha, both age 30. They both bought a chronic illness rider, very young. And then 15 years later, they go on claim. Number one is Mary. Number two is Martha. So Mary bought a chronic illness rider with upfront charge. And 15 years later, she reaches out to the company and says, she meets the eligibility criteria, wants to go on claim. And how much is she eligible to accelerate? The entire $500,000 death benefit is paid out over 4 years. How much did it cost Mary? $2,100. Now, to be fair, and this is an important disclosure, I pick young people here, but had they gone on claim later, her charges would have been higher, right? Or had the policy been issued when she was older, her charges would have been higher, right? So that point isn't the rider charge. The point is she is eligible to accelerate the entire $500,000 death benefit, and then the policy is extinguished. All right, chronic illness rider with charge at acceleration. Her sister, Martha, paid zero. She, paid premiums for 15 years. So while Mary had to pay rider charges every month, Martha paid absolutely zero. Then she goes on claim, reaches out to the insurance company, and they say, well, based on your age and the severity of your condition, your life expectancy, our discounting factors, all these things, you are eligible to accelerate $195,000. And And here's the kicker. If she accepts the offer, the policy is extinguished. So suddenly free isn't free anymore, right? I mean, depending on how you look at it, you could say that this policy cost her $305,000 to accelerate, whereas it cost her sister $2,100. Now, in the spirit of being fair and balanced, if Martha doesn't want to accelerate the policy, she doesn't have to accept the offer from the insurance company, right? She can keep the policy in force, keep paying premiums, or she can accept the $195,000, which isn't bad based on, you know, the premium she's paid, and if that's the circumstance she has to have. So again, it's not that any of the solutions are bad. It's just about managing expectations to our clients so that they know how they work. Because if Martha thought she could accelerate 500,000, you could see how she would be upset and why she might be contacting an attorney. And I got to tell you, you know, anyone's had any time in the field, nobody, or anyone at all, nobody wants to be named in a lawsuit, right? They don't just go after insurance companies. Sometimes, you know, or they always tend to name the agent as well, based on what I've seen. If you go to my website, I have this article, Wait, What? How much can you accelerate with chronic illness riders? I've opened it up to the public. So you can find that on the news tab if you scroll down and look for it. I just want to, if you want to know more about how incredibly varied these benefits are from company to company in terms of illustrating them, I wanted to share that with you. All right, so we've talked about Mary and Martha, and let's get back to our analogy. If you have a chronic illness rider with an upfront charge, you are now in a boat. So we've been downgraded from a speedboat, which was long-term care riders that are qualified long-term care and have consumer protections. Now we're in a boat, right? The first bullet I've highlighted for you, because I don't think this rule is being followed. You know, chronic illness riders are prohibited from being described or marketed as long-term care. They are not long-term care. So we shouldn't be, you know, describing them that way. And again, if ever there was a, you know, emphasis or a stamp that solidified that, it was the state of Washington. We have other states as well, where they specifically excluded the chronic illness riders. But with these chronic illness riders upfront charge, you do have known and predictable benefits. So if you have a $500,000 death benefit, how much can you accelerate? The entire $500,000 can be accelerated. Again, that footnote, with some companies, they might have like a 10% or a 5% residual benefit that they require to be set aside to be payable to the beneficiary upon death of the insured. Either way you cut it, whether it's for chronic or death benefit, the entire benefit can be paid out, will be paid out either for a chronic illness expense or when the insured passes away as a death benefit to the beneficiary. Chronic illness riders charge at acceleration, again, prohibited from being described or marketed as long-term care. If you're doing so, please stop. From an analogy perspective, we're still going to make it to the other side. But now we're in a canoe. It's just a different, a different solution that we're looking at. Sometimes with some of these riders, some companies require that the condition be permanent before you're eligible to accelerate. And that's why I ask you to look at the article. There's so many variations. Some companies will only provide care for facility care. Some companies have like a 2-year waiting period. It's just all across the board. The last bullet there, no underwriting, is again what makes them so appealing, right? There's no underwriting. It makes them easier from an agent's perspective to sell them. Plus the agent doesn't have to have a license, right? So the agent doesn't have to have the license. There is no underwriting, at the time of application, which makes them easier. And so, and then to top it off, they look better on the illustration. So do you remember when we looked at the pie chart? When we looked at the pie chart, we said 86% of the time, it was these solutions that were being sold. 86% of the time, it was these solutions that were being sold, where the amount eligible for acceleration depends. It varies significantly, depending on, every company has a slightly different formula, but you could be able to accelerate a third, 50%, 70%. There is the risk that you're eligible to accelerate 0. The only thing I can tell you 100% for sure is that you will not be able to accelerate under any conditions the entire $500,000 death benefit. And the reason why that I say that is because the charge and benefit amount are determined at the time of claim. The insurance company is going to charge you at least $1, right? Not to mention administration fees. So it's all the riders are good. It's about appropriately managing expectations of how they work. And again, the upside is, which is pretty significant, is no charge during the policy premium paying years. Nothing coming off the cash value or the premium. There are no drag of charges. So that's more cash value for your client, or more death benefit, or lower premium for your client. And if your client ever gets an offer they don't want, they don't have to accept that. All right, so what I want to hit now is critical illness riders. These are starting to grow a little bit in popularity, and they're also automatically being included by companies. What makes them different from chronic illness riders or long-term care riders, where you have 2 of the 6 ADLs or severe cognitive impairment, is that in order to be eligible to accelerate, you have to meet the exact named triggering condition. The ones that I bold are the most common ones, the cancer, stroke, organ transplant, renal failure. But some companies have as many as 15. So it varies significantly. Again, often automatically included, just like the chronic illness riders, up to a certain table rating or flat extra. Most companies have no charge until acceleration. The one exception would be John Hancock. They have an upfront charge, but they also have a known and predictable critical illness benefit on top of the death benefit. So I think we are close to the end here. I'm just going to hit a couple of more points here and then open it up to Carol. Some things to consider is, can the entire death benefit be accelerated to cover care expenses? And so then we have to know what type of rider we're selling. Do you need a health license or continuing education to sell? We know that qualified long-term care solutions require that. We had a great lesson in Washington. Other states are considering proposed finance legislation. And from the ones that I've looked at, it's looking like they would require qualified long-term care solutions as well. So that's so far, you don't know until it comes to fruition. But so far, from what I've seen, the chronic illness riders would not make the cut. If you have a qualified long-term care solutions, there are built-in consumer protections as well. So it's not just more work for the agent with the license and the continuing education, more work for the insurance companies as well. But it is a better value for consumers. And so the way I look at it is, if you are selling, a life insurance policy to a client and you mention a chronic illness rider or a long-term care rider, and you're in a 45-minute meeting with them or an hour meeting, and the majority of the time they're sitting there talking about the chronic illness or long-term care rider, to me, that would be a clue. That's an important benefit for them. And I would do whatever I can to get them the most robust benefit and start showing them other options. And then the sales applications, I'm going to flip to those here real quick. And that's just simply that, again, to reinforce that all the rider solutions are good. It depends on the priority objectives of the consumer. So the ones that kind of have had some negative press and that I feel like I've exposed today, chronic illness rider charge at acceleration discounting method, that's just simply saying you have a client in your office and they're saying, really not that interested in not really interested in accelerating for death benefit. And the reality is, when I buy a life insurance policy, I need a suitable need for life insurance, because if I don't have a suitable need for life insurance, then why am I here anyway? And then of course we need to recognize, when you accelerate for care, then you have a void for the life insurance death benefit, which was the original priority, right? So if you have a chronic illness rider, no charge at acceleration, I just wanted to point out one example here. You could have a client that's focused on supplementing retirement income or college savings, and they do not want to charge. They are fine with a free upfront rider charge, and then whatever amount that they are quoted, should they have to go on claim, if that were to occur, then they're happy to consider that at that time. And if they don't want to take the offer, they simply won't. So I'll end here with this slide. All of the rider solutions are good, all of them. The problem isn't any of the riders. The problem is are we adequately disclosing how they work? And are we managing expectations on how they work? As an agent, I think it's important for you as financial professionals, insurance professionals. If you don't know what you're selling, you're on notice now. So it's time to start digging a little deeper and find out what you're selling. And then in terms of what you've sold in the past, when you do your annual reviews, go ahead and get that in-force illustration. It'll have information about the rider. If not, call the company, but I'm confident it will. And then when you do the annual review, talk to your client so that you can kind of backtrack and appropriately represent how the riders you sold them in the past work, because it's better to address it now than to have your client be surprised when they go on claim. So Carol, I guess I'll turn it back over to you.
Okay, I'm sure that the entire group agrees with me that you make a very complex issue, opportunity, subject matter, very clear. However, we do have one question. Everybody wants to know if they're going to get the PowerPoint. And I did respond that yes, we are recording and they will be able to get the PowerPoint. Two, Sandra would like some clarification. She asks if all accelerations don't extinguish the policy, or will they?
I think that there probably could be some exceptions. And the reason that I say that is I've seen language where while you're on claim, the insurance company gives you the opportunity to continue making premium payments. So if you're continuing to making premium payments, that to me lends itself to it is possible for a remainder amount to be eligible. So at the beginning, when I said general rules of thumb, I said there could be exceptions. I would say that in the universe of the discounted chronic illness riders, you're probably going to find some exceptions like that, especially, like I said, if you can continue to make premium payments while you're on claim. But just as a general rule of thumb, if you've not paid an upfront charge, I would just go in there knowing that until you see something else. If you've not paid an upfront charge, when you go on claim is pretty much when the insurance company is going to do their underwriting. They're going to make the offer for you that this is the amount that's eligible to accelerate, and now the policy will be extinguished. So I would say by far, you are going to find that to be the case. You accept the offer to accelerate, the policy is extinguished at that time.
Thank you. And then George would like clarification as to whether agents don't need to be LTC certified to sell chronic illness riders.
So I don't know when he says LTC certified, if that has a different title, but I will say I meant that you need when you sell a long-term care rider or traditional long-term care or a hybrid linked benefit, when you sell those policies, you need to be appropriately licensed to sell them. When you sell a chronic illness rider, you don't need a special license. You can just have life insurance and sell a chronic illness rider, including those with upfront charges. So you do not need a special long-term care license to sell a chronic illness rider.
Right, it's a health product. So if you only have life, if you're only licensed to sell life, you won't be able to sell long-term care, but you would be able to sell chronic illness. Is that
right? And yep, that's exactly correct. And I like the way you used it, acceleration, because, I think that as an industry, we have a problem that, is part of our own making. And, I walk through pretty simply. If you have an upfront charge, you have a known predictable benefit. If there's no charge until acceleration, then, it's discounted and the amount that's eligible depends. So since we have two main categories of chronic illness riders, right? The more popular ones with no upfront charge, and the benefits vary so significantly, where there's, where the charge and benefit amount are accelerated at the time of claim with the more popular ones and the ones that have been involved in litigation. they both have the same name, right? Chronic illness riders often. And even if the company has a different marketing name, they have the same name. And so for me, as an industry, low-hanging fruit would be, why don't we address that? Naming convention. Labels are material, in my opinion. I mean, I've been saying this now for 2 years. I don't know who I need to talk to. I find someone with some muscle. I don't know. But to me, if the chronic illness rider has upfront charge where you can accelerate the entire benefit, known predictable benefits, they, for example, could be called chronic illness riders. The other ones that are accelerating the death benefit where the amount is unknown, where everything is, calculated on the back end, just call them something else. Give them a different label. That makes it easier for the agents right off the top. And then another issue I want to add here real quick, and I'll let someone comment, is, and I think this might, onus might fall a little more on the insurance companies. And of course, insurance companies have the right to, design their rider solutions as they want and illustrate them. But as not just insurance company, but as the insurance industry, I think that we need some illustration standardizations, which is why I referred you to the website. And that's because, you're an agent and you have 4 illustrations in front of you, and they all have a chronic illness rider. And so now you're sitting there, honestly, attempting to do your due diligence, right? You're going through, doing your due diligence, and you're trying to make comparisons, not only of the underlying base chassis, which is certainly a priority, but now you're looking at the riders. And then as it turns out, you find out that one company is showing you a lump sum amount. Another company is showing you an annual. So one company is showing you the lump sum and the policy is extinguished. Another company is showing you a chronic illness annual benefit. Another company is showing you a monthly benefit. Some are showing it paid out over 3 years, some over 4 years. It's just all across the board. And that's a lot. That's a lot to look at. And wouldn't it be nice if there were a little bit more standardization so that it would make those types of comparisons easier?
What you're discussing kind of reminds me of what we heard Steve Kane say this morning during the behavioral finance time that we spent in that session at 10 a.m. Eastern. Understanding yourself, understanding your client. I think if you really understand, well, Ramona, you said this too. What is the client trying to accomplish? Are they looking for life insurance? Are they basically looking for long-term care? Are they looking for chronic illness where they recognize that it has to be what is named in the product that you're showing them, that illness? Or is it just that they say, when this is where I think all of us are concerned, that an agent would say, hey, I'm going to get you chronic illness as well at the time of the sale. Well, 15 years, 20 years later, this person thinks they have coverage because no one explained to them exactly what it is. So I think the takeaway here is that there are tremendous differences in these products. And I think your illustrations, Ramona, really call out that this is something you can figure out, but it starts with your client. And if you know, as Ramona and Steve and most of us would say, what's the objective of the meeting? What is it that you're trying to accomplish with this particular client? And then you would know, am I doing the right thing? There is another question here, Ramona. It says, if an insured collected the full face amount as a long-term care rider, and they did not continue to pay premiums, would there be an income tax issue? Now, I know we don't give tax advice, so that's kind of a hard one to answer.
So, that's like the normal. When you accelerate a long-term care rider, you can you're able to get the benefit for the greater of, and not have a tax implication for the greater of actual expenses incurred or the HIPAA per diem, right?
Right.
So that amount won't, that's not going to change. But if you're taking, larger amounts, like an annual payment versus a monthly payment. So let's say this company gives you the opportunity to accelerate an annual payment, and then it turns out your expenses end up being far lower, then that could subject you potentially to income taxes.
Right, which I think calls out a good difference between the indemnity and the reimbursement. We often hear that with indemnity, you don't have to show your expenses, but you better keep records, or you better tell your client to keep records, because it speaks exactly to what you just said, Ramona. If it doesn't match up, the amount that you were given and the amount that you spent, then you should obviously consider seeing your tax advisor.
Correct. And all the companies that you work with, and they all have advanced sales shops, and they have wonderful pieces on FAQs, and they have wonderful tax summaries. I've seen nice ones from 5 to 10 pages all the way up to 20 to 30 pages. So if you're not using your internal wholesalers and their advanced sales resources, I would encourage you to do so. Get those pieces sent to you so that you can understand how these work, because like Carol said, none of us give tax advice.
Right. Well, we're kind of at the end of the hour, so I would give all of you a moment, if you have another question, to put it in the chat. I didn't understand the other question that's in there about why would you pay anymore if you use the whole amount for.
Can I ask a question here?
Sure, Winnie, go ahead.
So if the person claimed the full amount of the long-term care rider, whatever let's say they pay 100%, technically your life insurance is still have to pay. So what happens if we don't pay, the client don't pay?
Oh, I see what you're asking. Ramona, do you get it?
No, if you could repeat the question, please.
All right. There is a long-term care policy that has a acceleration of benefit rider. The person accelerates the benefit rider, but it doesn't use the entire death benefit, but they stop paying the contract. What's the consequence?
Right. So I am just going to go.
I think my question is, let's say the person have $500,000 coverages and they're getting a 10,000, is it like, no, 250. Let's say they're getting 10,000 a month. And in about 40 months or 60 months, they use up the face amount of the policy. But because it's a life insurance, it's supposed to continue to pay. So the person collect the full face amount that they qualify for long-term care rider. And then why would someone continue to keep that policy? Well, you already use up the intention for that long-term care benefit.
Yeah, so that I definitely agree. So if you have, I think I used 500,000 the entire time here. So it depends on whether it was a chronic illness rider or a long-term care rider. But the point is that if you have, in your example, $1 million death benefit, and you've accelerated the entire $1 million for care, because originally it was a death benefit, a life insurance death benefit. If you've accelerated the entire $1 million to cover your chronic illness expenses or cognitive impairments, then the policy has been extinguished. There is no, there is no further premium to pay. And some companies, they do require you to pay premium while you're on claim. Some companies do not. And this is another example of the difference between the consumer protections offered and afforded by, qualified long-term care versus, other solutions in the market. So for example, if you have a long-term care rider or a hybrid linked benefit product or a traditional long-term care, those have the consumer protections, right? Where you have lapse protection while you're on claim, so that even if your policy would otherwise lapse, if you're receiving facility care, so even if you're not paying premiums, if you're receiving facility care, the insurance company cannot lapse the policy on you. So I just want to wrap that last example up again. If the whole point of what I wanted to share with you today is, when you have a long-term care rider or a hybrid linked benefit, the benefits are known and predictable. You can accelerate the entire death benefit for care. And some companies will even give you an additional residual death benefit, 5 or 10% of the death benefit, to pay the beneficiary when the insured passes away. So those are long-term care riders, hybrid link benefit. And with those, you even have an extension of benefit. With chronic illness riders that have upfront charges, again, you can accelerate the entire death benefit. You can accelerate the entire death benefit. And then if there's any remainder amount, it will be paid to the beneficiary. And those are the ones that have upfront charges. Now, for those that have no charge until acceleration, the amount, again, that is eligible depends. You might only be able to accelerate a 30%, and then the rest of the policy is extinguished. So again, they would pay it out in a lump sum, and then the policy would be extinguished. Some companies would pay it out annually. It's just across the board. It depends. So again, I started off with rule of thumbs to make it easier, and I hope it didn't. I hope we didn't get in the mud here on the back end. But if anything, let me leave you with this. It is time for us to know what we're selling. So if you're unclear about which type of rider you're selling, how much can be accelerated, whether premiums need to be paid when they're on claim, if there are consumer protections, what happens upon death of the insured, is there residual death benefit? If anything, because I can't answer the questions for the entire industry, I can just make general rules of thumb. But if anything, I'll leave you with this. Find out what you're selling to your clients moving forward, and take a look at what you have sold so that you can, with your clients in policy reviews, so that you can adequately represent them. Because I think as an industry, we all have room for improvement.
Well, today's session certainly gives people a good deal of information to look back over, and I agree with you. In doing a review, it's important that you and they understand exactly what you have and that you document that you reviewed it with them. I'd once again like to thank the Intercompany Long-Term Care Conference for sponsoring this session. I inadvertently typed in ILTCI CON, typo G. It's f.org. I would strongly encourage you to visit the site. We're having our conference in December. It's a wonderful time of the year to be in Denver, March 12th through the 15th. And we'd very much like to see you there. So thank you, everyone. And we will now again take a short 10-minute, 12-minute break and then have our last session. Thank you again, Ramona. You're always such a wealth of information. I really respect how well you organize a very difficult, complex topic. And we will be sending out the information to all of the attendees, and we'll see you again soon, I hope.
Thank you.
Thank you.
So yes, as Carol mentioned, we do have one more presentation at the top of the hour. We will be back in just about 10 minutes with Cindy Harris from LifeSecure. And don't need to go anywhere. This is still the link to be in this meeting. So we will see you in just a short while here. Thanks so much.